I want to say welcome, everybody. We are back for Ask the Expert, and we have really, not to slight my other experts, but we have one of my favorite experts of all time, and I'll explain why here in a minute. But we have David Howell of McEnearney Associates, and we're going to talk about the state of the market today. But I first want to thank you to Ask the Expert. We are back and looking forward to a 2022 where we bring you lots of great local experts to talk about a whole host of topics. And if you've got something you want to hear about, certainly let us know. We are happy to learn from our experts and happy to bring that info to you as well. Every couple of weeks, twice a month, we interview a local expert on any host of topics for about 30 minutes. And this is also recorded. It will be on YouTube. It will be on my McClure website, and we can always send you a link. So this one or any other, if you miss it or you want to tap into us and ask about a topic, we may have already done one. We can send you the link. We can forward it to somebody who you want to have the info, whatever makes sense for you and how you want to get or disseminate information. We're happy to help with that. And we're just happy that you tuned in today. So thank you for joining us. Again, my name is McClure. I'm a residential realtor with McEnearney Associates, and I'm licensed in Virginia and Maryland. And I serve Northern Virginia and Montgomery County, Maryland, primarily, and some other areas that adjoin those. And today, our special guest is David Howell. David, thank you for joining us.
It's an honor, Ann, always.
So David is the Executive Vice President at McEnearney Associates. And David was also recently honored by the Virginia Realtors. He received the 2021 award for, I'm trying to remember what it was called, David. I'm going to describe it because I looked it up. This award is given to members who have made extraordinary and distinguished contributions to the real estate profession and markets in Virginia over a 25-year period or more. And so David was recognized as a really special individual very recently, and we at McEnearney Associates certainly agree with that. So I want to congratulate you again, David.
Thanks, Ann. Much appreciated. I just think of it as the old guy award. So I've been around a while. So
it is the Virginia Realtors Hall of Fame, and I think to be any Hall of Fame, you have to have been around a little while, but also made really good contributions. Well, and I know you've done, by way of background, David is one of my mentors in the business. And I met David in, we were just saying 1994, and worked with him on his staff before becoming a realtor myself. And so David has heavily influenced my career. And one of the things I've always loved about him is that he has a way of conveying information. You may have heard him on WTOP. There have been sound bites. He's been interviewed in the Washington Post, among other places, but some noteworthy ones here locally, and then a lot of the real estate trade journals, National Association of Realtors, down to the Northern Virginia Association or the Greater Capital Area Association. So he's really a noted expert. And what I've always loved about you, David, is how you can take all of this data and boil it down for us in ways that we can give to our clients and folks we're talking to when we're out working in the field. You have a way of making it very understandable, very bite-sized and easy to take in, because it's not always easy to take in data. And I appreciate that you do that. And I'm glad that we're going to share some of that today.
Well, thank you, Ann. And believe me, I always learn from you as well, too. And all of our colleagues here at McEnearney Associates. We're very fortunate to work with a lot of really great people.
We have a really good team, I have to say, and we have some very good anecdotes from the field. You helped me with one recently that was particularly difficult. I sometimes share factoids when we start Ask the Expert, if we're speaking with a roofer or HVAC or whomever. But since we're going to go into that in the body of this, I'll just share some anecdotal information that I would say that we came off a very, very wild ride in 2021. And I don't know if the peaks of the roller coaster have gotten even higher, but it sure feels like it's higher and faster right now. I was involved in one recently that you actually helped me with, where my client submitted an offer and they were one of 25. And while we wrote a spectacular offer, I mean, just an incredible offer, we didn't even break the top 8. So
yeah, amazing.
It's really shocking out there. And I want to talk a little bit about that. But before we get into predictions and what we see going on right now in this very, infantile part of 2022, can we talk a little bit about 2021 and what happened? And would you give us a little bit of a review there?
Yeah. Well, and I liked your analogy to the roller coaster. I was listening to a guy this morning. In fact, it was Dave Ramsey, and he was talking about the volatility of the stock market. And he probably stole this line from somebody else, but I want to give attribution because he said the only people that get hurt in a roller coaster are the ones that jump off during the middle of the ride. And I think there's a lot of truth to this market right now as well, too. We are in the market that we're in, and it is a little bit crazy. But for people that are interested in buying or selling, it's a great time to be doing that. I know that sounds like typical realtor stuff, but having been doing this for 37 years, it's amazing to me how often the markets change. This one's different than the other one that we've seen. But to your question, 2021 was a very solid year. We know that 2020 was crazy because of the impact of COVID, and it pushed the spring market into the summer and the fall. One of the things that happened in 2021 is we saw some return to seasonality, where the spring was the strongest market. We had a very solid summer and fall. And one of the fascinating things about it is that December, the market really took a hit. And I think there were two reasons. It still doesn't change the impact of the year. It was a great year. But I think the biggest reason for the hit in December, it like buyers and sellers both took holidays. And I think some of that is literal. With COVID's impact of people not traveling much in 2020, there was so much pent-up demand for holiday travel that between Thanksgiving and Christmas, we saw the impact on traffic on the roads and everything else. There were a lot of people that were traveling and not thinking about real estate. And because of the surge in Omicron, an awful lot of sellers decided to sit on the sidelines. And so we had a huge drop off in the number of new listings, huge drop off in inventory, and a pretty big drop off in contract demand as well, too, which kind of sets the stage for what we're looking at now in 2022.
Yeah, the intensity is shocking right now. And it's funny that you say that about the seasonality. Not funny, haha, but in the fall, I often have found myself saying to people, I know your lease goes through April 30th, 2022, but I promise you that if I could wager a ton of money and I had a crystal ball and I could show you, I think you're going to do better if you break that lease. And by now in November, December, I mean, that's past us, but it's very interesting how that seasonality works, where the intensity of this market with the number of offers driving the prices high, they probably would have fared better to break a lease in the fall and, pay those damages than what we're seeing now with the prices, because I think the intensity of this market is just sort of, it's scaring buyers, frankly, I think.
It is. And frankly, they're not wrong to be scared, because as crazy as this market's been since the onset of COVID, where the market just fell off and then it came roaring back, I think right now in the month of January, in almost the entire metropolitan area, we're dealing with an inventory deficit like we've never seen before. And it's part because we entered the year with very low inventory, lower than normal, lower than the normal low December inventory. And the reality is buyers are coming back to the market quicker than sellers are. And so we've got this unusual confluence of events with really low inventory and sort of an amped up demand. And this may be jumping some of your other questions, but I think part of the reason for the amped up demand right now is that people, I believe, are correctly perceiving that mortgage interest rates are heading up. And historically, what we've seen when mortgage interest rates start to rise, it brings the people that have been sitting on the fence off the fence. Once people perceive that the bottom has been passed and it's heading back up, there's I think a correct perception is, if I'm going to buy, I better start thinking about it now rather than waiting until the rates are a half a point or a point higher.
Right. No, I think you're right. And I don't think the little snow events helped. And like you said, Omicron, I think sellers fell behind, but buyers were like, I'll put my mask on and get out there, So yeah, it's interesting. You had shared a statistic, I think it was 2 weeks ago, that we were at 41, I think it was percent fewer listings on the market than we were the same time last year. And last year it was really low.
Yeah.
And interestingly, I read something nationally that percentage is not that far off throughout the nation.
Yeah.
So we are at a severe deficit. I ran into a woman at an open house who was British this past weekend, and she shared with me, she's an agent, she shared with me that she's speaking with her friends in the UK, and she's got some realtor friends also in New Zealand and Australia, all experiencing the same thing. So It's very dynamic.
It really is a global issue in the developed economies, where there just aren't as many people selling as we would historically expect to see. And forgive me for one little factoid, but you obviously are a Montgomery County expert. When you think about Montgomery County, think about all the townhouse communities that are out there. You can drive through Gaithersburg or Germantown or Rockville, and you see rows and rows of townhouses. On the 31st of December of 2021, there were 94 townhouses on the market in the entire county, which is staggering.
All price points.
All price points, all geography in the entire county, 94 townhouses.
Okay, so, and when was this?
That was 3 weeks ago, end of December. Now it's come up a little bit since, but I've never seen a number that low ever in Montgomery County. And that's just a number I'm kind of plucking from midair there, but we could look at similar numbers almost throughout this entire region. In fact, we've talked about this before, about the only place where there is a relative abundance of inventory is in the close-in condo market. But everything else is critically low inventory.
Wow, that's incredible. So I would say, to people watching this, or people watching this who have friends or family, if you know a snowbird who's been saying, yeah, at some point I'm going to sell, I'm going to move to the house, and I'm going to turn the condo in Florida into my primary, or we need to downsize. This is a great time, right? I mean, the inventory is never lower, and the demand is ridiculously high. I mean, this is a good time to get off the fence, and there are realtors out there. We can help you get your homes ready very quickly. So if it's trepidation about how do I turn it around this quickly and capture this market, there are people who can help you. We can help you,
Yeah, no, absolutely. And again, it sounds like typical realtor speak to say, man, this is a great time to sell. But the fact is, man, this is a great time to sell. But I'm an unabashed capitalist, and markets seek balance over time. And the current conditions where we have this significant imbalance with not enough inventory and more than enough buyers, and very frustrated buyers as a consequence, this will change in part because it has to. There will be more sellers that are enticed into the market, appropriately so, by this. And there will be buyers who are so frustrated by the lack of inventory, they decide to sit on the sidelines for a little while. So I really believe that this feeding frenzy that's going on right now will be relatively short-lived. Still a seller's market, we're anticipating for all of 2022, but not as crazy as it is right now.
Okay, so that really does lead into my next question, which is sort of what we think buyers and sellers can expect this spring. So it's funny because when we're out and about now in January, we get that question. Now, when is the spring market coming? And I'm like, the spring market came on January 2nd, right?
We haven't told Mother Nature that, but the spring market's here right now.
I wish the spring market would tell Mother Nature. It's so much easier to not have to navigate around ice and snow. But the spring market's here. So what would you, if you had to guesstimate, and you and I have talked about this intensity and sort of where you think things will be 4 to 6 weeks, maybe 3 months from now, if you were to kind of advise a buyer and seller, hey, here's what I think we're going to be seeing, what would your best guess be?
Yeah, well, I really do believe that because we're a few weeks away from the normal influx of listing inventory. And we are going to see that. I mean, that's just historically the norm where we'll see that. The only disruption I've seen in 37 years where we haven't seen a big influx of listings in the spring was in 2020 when COVID hit and people just kind of hit the pause button on everything. So for buyers that are out there, just know that there is hope coming, that there will in fact be more listings coming on. And I really do believe that the nature of the inventory deficit we have right now does not get made up overnight. In fact, it's not going to get made up this year, but it will get a bit better. So in some places where we have a 10-day supply of homes on the market, like we do in Montgomery County townhouses, it's probably going to be closer to 3 or 4 weeks of supply by the time we get into mid-March, late March. That still really tilts the scales in favor of the sellers, but it does give buyers a few more choices. And as I know I've already said, I think buyers have come into the marketplace sooner than they ordinarily would have for a variety of reasons, including interest rate pressure. But we are going to get to be a little bit more balanced than we are right now, but it's still going to be frustrating for buyers.
Well, it's interesting. Would you say that historically the bulk of our listings have hit sort of in that March, April timeframe
Yeah.
here
Yeah.
in Pro?
Yep.
So yeah, so maybe another 4 to 6 weeks before we start to see if this tracks like other years, before we start to see more of that going on.
Yeah. And you and I've talked about this many times over many years. The decision to buy or sell a house is an intensely personal decision. And I've never been a big believer in trying to time the market, because the right time to sell is when it's right for you personally. And the right time to buy is when it's right for you personally to do that. And so no one should rush out and sell their house because the market's great right now. But I will say that if it's on your horizon to sell this year or to sell sometime in the next 6 months, accelerate those plans, and do it sooner rather than later, because my crystal ball, which is always cloudy, gets really cloudy when we start talking about 6 or 7 months out. We don't know what the impact of inflation is going to be. We don't know what the impact of rising interest rates is going to be. And so I expect this to be a very solid market all year, but I expect a lot of that's going to be front loaded. I think the market's going to be much stronger in the first quarter, in the first half of the year. We get into the second half of the year, I think things will get a lot more calm than they are right now.
That's nice to hear for a lot of people in this marketplace.
Yeah, you bet.
And that's, you mentioned something about interest rates and people kind of getting off the fence as they see them rising. I sometimes tune into what Lawrence Yun is sharing, and he was the chief economist at the National Association of Realtors, and he had talked about these 4 interest rate hikes, and I know there's not a direct financial correlation, but there is, as you have said, a psychological one. I think that first rate happened maybe a little earlier than some of the forecasts. And do you think we're already seeing impact from that in terms of it translating into actual sales? Or I know you said in terms of people getting off the fence and the desire out there, but how do you think that's impacting the market right now?
Yeah, and we've already seen mortgage rates go up a little bit more and a bit more rapidly than anticipated, certainly more than I anticipated. But I still haven't seen any housing economist forecast rates above 4% anytime this year. It could happen. Markets hate uncertainty, and right now is a very uncertain time, having nothing to do with real estate. When you think about, again, the impact of inflation, where the Fed's clearly going to try and tamp things down by rate increases, which, as you said, don't directly impact mortgage interest rates. When you think about some uncertainty in the international events, between what's going on between Russia and Ukraine and China and Taiwan, there's just a lot of going on that makes investors uncertain. All of that uncertainty tends towards higher rates. And so it's a real change in attitude for buyers or potentially buyers that are used now to almost a decade of sub 4% mortgage interest rates. That won't stay that way forever. And Andy, and I'm sorry to be rambling here a bit, as you and I have talked about many times, we both had the privilege of working for John McEnearney, who started our company 41 years ago. And when the company started, mortgage interest rates were 17%. And when people hear that number, go, well, holy cow, no one was buying and selling houses. Well, they did, because people need to live somewhere. There's an imperative for that. So while none of us want to see rates go higher, the reality is it's not time to hit the panic button. Houses are still more affordable today, despite higher prices or anything else, than they were a decade ago.
Putting it in perspective, that's like 6 times higher than people have been seeing over the last year, maybe even a little more than that. But yes, people were still buying. And you know what? I like to tell my clients who are freaking out, call a good local loan officer and have them run scenarios for you.
Yep.
You can tell them you're tied up, personal business, whatever. You can't possibly make a move before X this year. Well, what if interest rates are 4%? Well, have them run a scenario for you, and you'll find out what that, what you're looking for in a home and where you're looking for it and how much you can afford. They can run for you. What would your payment be? And so, historical perspective tells us 4% still really, really good, right?
Really good. You bet. Yeah.
But it's coming off of 2.5, 3 that you're like, oh my gosh, rates are going crazy. And it's,
Yeah.
again, as with anything, perspective. So speaking of perspective, David, we see these transactions. I mean, you and I have talked about some wild ones. I was helping a former McEnearney employee recently on a property in the greater Rockville area. And, it was listed just over $1 million and top offer would go just over 1.3. And we're seeing that kind of thing all over. Well, when you see that, you go, my gosh, homes are appreciating 25% or whatever the percentage is. But that's not really a realistic picture too, because
no,
the wild ones might go like that, but you've got plenty that don't. And so the averages throughout our region over the last year have been like maybe 6 to 10% appreciation, depending on the area.
Yeah, you bet. And you're right. There's always those outliers where you get something that goes way above list price, but that's just that. They're outliers. And the reason we remember them is because they're outliers. If everything was going up 25%, that's kind of what we'd be used to or comfortable with. But I think if we were to try and peg an appreciation rate for the metropolitan area in 2021, somewhere between 8 and 10% is a pretty good number. Obviously, some properties do much better than that. Some properties didn't appreciate at all. But as an average, that's kind of what we're looking at. And I think that we're looking at more modest appreciation rates in 2022.
Okay, that's good to know. I mean, as you said, certainly the last couple months of 2021 impacted the averages,
yep.
Right? Because it just wasn't as wild and crazy as it is now. So, so if you were talking to a buyer who's just watching all of this and getting discouraged, what advice would you give them?
Patience. Take a deep breath. Have some patience. And I'm not suggesting that you just sit on the sidelines and let your dream house go by the wayside. But the thing that concerns me most when we're working with buyers, even though I recognize, as it should be, it is their decision. It's their money. It's not our money. But try really hard not to get caught up in the feeding frenzy. Without being specific, there are 2 or 3 instances that occur to me from the feeding frenzy periods of last year, where we've had very smart, educated buyers make decisions that I think are a little cringeworthy, that they got caught up in these multiple offer scenarios, and their objective became winning rather than making a sound financial decision. And we all get that. It's an emotional process when you're buying a home that you're planning on living in. And again, not suggesting that people shouldn't make those decisions, but we do hope that people will pause before they really go way out on that limb to potentially overpay for a property. Now, if they're going to live in that property for 20 years, that's perfectly fine. But if they've got a shorter term horizon to live in a property that they're paying an absolute premium for, part of the calculus has got to be, if I have to sell this in 4 years, am I actually going to be able to sell it and not be upside down on it? So that's a rambling answer to your question. But the other thing, other than take a deep breath, is remember, there will be more listings that are coming on the market. What we're dealing with today is not what we're going to deal with tomorrow, and is not what we're going to be able to deal with 3 weeks from now.
And if I could add to that and give a bit of advice to prospective buyers, whether you're 6 days, 6 months, 6 years out from buying, something I like to say is look at the ugly houses, because it's curable. Most problems that are aesthetic in nature are curable. Not all, but most. What's not curable is backing up to 66 or 270. But if it has wallpaper and it's got ugly shutters and terrible landscaping, we can cure all of that. And sometimes those houses are on less of a roller coaster, and you can do a lot better. I think we've kind of fallen into this pattern of form over function, and so many of us fell in love with Chip and Joanna, right, on HGTV, and it's like you go in and I like them too.
Yeah.
After a long day, I'm sick of real estate sometimes, and I just can't watch anymore. But I think they're great, and it's like, listen, we can add shiplap. We can totally get that look, and so I always tell people, please look at properties in terms of is this thing that you do not care for curable? Because a lot of times other people will overlook something that's you know, I'd rather have the little old lady's house who's owned it for 50 years and tons of wallpaper and carpeting, but it's been cared for and it's been maintained and the gutters are cleaned and the HVAC is serviced. And, you know, I'd rather have that for a client than 150,000 over on something that's.
Well, you bet. And forgive me for telling a story, but our youngest child, who you've known literally since birth, got married last year. And she and her husband decided they wanted to buy a house, and they fell in love with a house in Reston. They were one of 13 offers. I was not their realtor, fortunately, because I probably wouldn't have been very objective. And they made an above list price offer. And honestly, and I told them this, I prayed that they wouldn't get it, and they didn't get it. Because had they gotten it, they would have been overpaying for that house. They turned their attention to a house that had been on the market for 90 days, which was really unusual in Reston. Great house. I wouldn't say it fell into the category of an ugly house, but it needed some work. And the reason it had been on for 90 days is it was overpriced, pure and simple. And so they were able to negotiate. Imagine that, a buyer being able to negotiate in this market. They were able to negotiate a below list price offer with some seller concessions. And they're very happily ensconced in that house in Reston because they had some patience. And I can't say they listened to their father or father-in-law, because they didn't. But I think ultimately they are glad that they didn't get that first house and didn't get caught up in the frenzy.
You know, I mean, it's such a valid point, and you can do so much with $50,000. I mean, 50,000 is a lot of money, but imagine this very similar house that's all dolled up and it's kind of lipstick on a pig gets bid up 100,000, and you get in and you peel back the layers and you're like, oh my gosh, I've now got $75,000 worth of work to do versus the one that, you know, wallpaper, shutters, landscaping, to use my example, or whatever it was at your daughter's house. And you can spend 50,000 and get there also, and you didn't get bid up. You retain some. So there are still homes like that out there, and every week there are homes that fall out of contract. I mean, we have a lot of fallout right now, so keeping an eye on those. You know, we've talked a lot about buyers and where their heads are and how, you know, they've really got to be strategic in this market. But because it's been such a seller's market, do you feel like there's a bit less of an emphasis on getting a home ready, staging it, doing some repairs, preparing the home than there was prior to this madness we're seeing? Yeah,
there has been. That doesn't mean there should be, but yes, there has been. If there's ever been a time that a seller can sell without having to fix up their house, it's now. In fact, I would say that pretty much any time since we started the rebound from the initial impacts of COVID. Because there is so little inventory, which I know we've talked about, and so many buyers, which I know we've talked about. However, we also see consistently, just because a property can sell doesn't mean that it's getting its maximum value. And I loved your lipstick on a pig. The fact of the matter is, buyers are attracted to something that looks nice, as that's human nature. And so making those small cosmetic repairs, making sure that the yard looks good, although it's hard to do this time of year, that the house is well organized and cleaned up, and that you've taken care of those minor maintenance issues, really pays big dividends for sellers. Again, even in a frenzied market where people are overpaying for properties, they'll pay even more for a property that looks good. Yeah, I always feel like put a little effort in, $5,000, $10,000, $15,000, and you know, 15,000 is nothing to, you know, snuff at, because it's a lot of money. But you know what? When it gets you a $50,000 return, it's worth it. Every penny times X, right? So you bet. Yeah.
I want to go on because I know we're getting tight on time. You know, McEnearney has a new service I wanted to talk a little bit about, because one of the big things in the news over the last year has been something called iBuyers. I like the letter I. And McEnearney partnered with a resource recently called Zavvy, just to allow our clients access to that type of buyer and market. And I wanted you to talk a little bit about what an iBuyer is. It's been prevalent in some other cities before it came here, but we're seeing more and more of it. I wanted you to talk a little bit about what it is so people know what it is, and what this new resource is that we have to help deal with that, or help utilize that.
Well, an iBuyer is an institutional buyer. They tend to be, and some are quite large, backed by Wall Street money. Others are more local, and probably seen for years the We Buy Ugly Houses advertised on television. That's essentially an iBuyer as well too. They will buy houses, And their intention is, from their perspective, is to buy a house, put some modest improvements into it, and flip it for a profit. That's the short version. There's plenty of other iterations of that. From the seller's perspective, what an iBuyer offers is speed and certainty and non-contingent purchases. But that comes at a cost as well too. iBuyers typically don't offer market prices, and they usually will deduct from the offer that they're making what their projected fix-up expenses are, and that's neither good nor bad. The reason that we partnered with Zavvi and that we're looking at this is we have always believed that as part of our commitment, part of our responsibility to our seller clients, is to make sure that they are exposed to all potential offers for their home, whether that's from an end user, whether it's from an investor, whether it's from an iBuyer, so that they can make an informed decision. And forgive the brief aside, it's one of the reasons that we're not fans of private exclusive listings, where we're selling our listings only to McEnearney agents. We love helping our sellers, but if with our 360 agents, whatever number of buyers that we have is a limited pool. There's 92,000 agents that are part of our multiple listing system. So we believe in the broadest exposure possible. And part of that is, for sellers who are interested, is to see if there are any iBuyers that are interested in the property out there. Most times when there's an offer from an iBuyer, the seller rejects it and opts to go on the market. And we're fine with that, because ultimately our objective has been to give them exposure to their options. I will, as a brief aside, and I hope this doesn't sound like a dig at Zillow, it's not as easy as it looks. Zillow lost about $500 million over an 18-month period of time in their efforts to buy massive numbers of properties and flip them. And they found valuing a home by a computer algorithm has its limitations, and they ended up overpaying for an awful lot of properties. The only winners in that were the sellers of those properties. But the losers have been Zillow shareholders, investors in that, and a downward reset of the market when those properties had to get dumped at less than market value just to have Zillow get them off their sheets. So sorry if that's a bit of a rant on Zillow, but like any major financial transaction, it shouldn't be done on a wholesale basis. It needs to be looked at individually, as whether that offer makes sense for the offeror as well as the person who's selling.
You know, you've often said over the years that you do the best for your client when you cast the widest net.
Yep. And
so it gives us one more tool to cast that net as wide as we possibly can for our sellers.
Yep.
And it's nice to know that we have a response to the questions about iBuyers in the marketplace. We're still exposing the homes to the market in, you know, the traditional sense. And we've got these other options as well. And like you said, just gives our sellers one more tool in their arsenal. You know, have you heard the stories out of cities like Atlanta, where they've got these corporations and things coming in and like buying up? Is that similar to iBuyer or no?
Yeah, it is, but they have a different end result in mind. And to some degree, when Zillow decided to get out of the iBuying business and sell their inventory to another large investment pool, in fact, I think they've gotten rid of about 2/3 of their inventory to investment companies. And I'm not saying this shouldn't be allowed, but there's a real potential impact from a public policy standpoint. So, and to your point, and I've heard rumors in Houston that 25% of the market are these institutional buyers who are buying properties not to fix them up and flip them, but to hold them in inventory and rent them.
That's what I've heard.
Yeah, you bet. And I think that's what we were talking about in Atlanta as well too. From the investor standpoint, that might be a really good strategy. From the public's standpoint, that's taking a significant portion of the inventory that would ordinarily be churning through the market and taking it off the board altogether and turning it into rentals.
It creates more desperation on the buyers.
Yeah, it actually, right. And it actually creates a potential longer term impact of having even less inventory than we have now. So again, I'm not saying it should be outlawed or anything else, but there's always unintended consequences to making decisions on Wall Street in terms of return on investment, as opposed to what's good for the housing economy overall.
Yeah. Okay. Well, just curious. One of the things that's always been good about DC Metro, and maybe it's because we've got Maryland, DC, Virginia here. Maybe it's just the way the whole region was developed, but we're so varied in our housing styles, prices, ownership, you know, whether it's co-op or condo or fee simple. I mean, we really have so much diversity in our housing styles and prices that I think that makes it harder for some of these organizations to get in here, right?
Yep.
David, I know we've run over. I just want, as we wrap up, to ask you any other predictions for 2022 or advice to buyers and sellers that you'd like to give as we wrap up?
No, and frankly, to emphasize what we've been talking about, these are individual decisions rather than global decisions. But I will say this, having been a student of this market for 37 years, we're very blessed to live in a wonderful area, not only in terms of lifestyle, but we've got a very solid regional economy, a very solid employment base, even though many of us are working from home rather than the office now. I think the long-term prospects for this region remain very, very solid. And we're actually, there's some demographic trends that I think set us up, not just locally, but nationally as well too. We have an enormous influx of millennials that are reaching house purchasing age. I think there's something like 7 million millennials in the next 2 years that are turning 30. And that is the prime house buying age. So you take that influx of household formation and a large potential pool of purchasers, combined with a low inventory situation that isn't going to change overnight. And I think we're looking at a sustained period of time of a relative imbalance between supply and demand, more demand than supply. So no guarantee on that. And we know that's never permanent as well too, because birth rates are dropping. So 10 years from now, 15 years from now, that equation could be flipped. But barring some enormous international cataclysm or some other horrendous pandemic, we are set up very well for a sustained period of a very healthy real estate economy.
I feel like we've had our share of pandemics. I hope it's another 100 years before we go through this.
Well,
again.
You bet.
But it is interesting too to see trends, like you said, birth rates and also combined households. I see more and more people doing the accessory dwelling units.
You bet.
And selling a home and buying new construction to give mom and dad an apartment in the lower level or whatever. So,
yep.
David, I just want to thank you again for coming. It's been such a good discussion, and it's very optimistic. I think sometimes we focus on the negative, so it's really good to focus on, hey, great time for sellers. And you know what, buyers? Still fantastic interest rates, still a good time. You know, we know what's happening right now in the market, and right now it's a good time to act. So
yep.
I want to thank you for joining us today. I want to thank you personally for mentoring me in real estate. And
thank you. And believe me, I've always learned more from you than the other way around. That's not an exaggeration.
I don't even think that's true. Oh, yay. Here's David's. Congrats. Yes, Virginia Realtors Hall of Fame. So
nothing says Hall of Fame like a vase. So there's my vase. So
I love it. We have to get you some flowers to thank you for joining us today. So to everybody watching, we want to thank you. We hope you will share the link with friends and family. If you've got questions, certainly reach out to us. We're always happy to answer whatever we can. We'll have another great episode in a couple of weeks. We're going to kick off some organizational tips. We've had a lot of people over the last year not sure how to get rid of stuff. So if you're clearing out, you're trying to figure out what to do with your things, where can they be donated or recycled or whatever, we're going to have a great expert on to talk about that. So we hope you'll join us again. David, thank you again. And
thank you,
and Jennifer, thank you for behind the scenes, Jennifer. We'll catch you guys next time. Happy New Year.
Thanks, ladies.